When the market opens, where is the money? Stay tuned, traders. We'll talk about that next. Good day, traders. I'm Stacey Burke from Stacey Burke Trading. It's the weekend. Hopefully everybody's had a good trading week. Some of the things that maybe you improved on, other areas that you maybe need to target for next week to improve upon, reviewing the week, your performance. Hopefully you had improvements in your trading. I know some traders have emailed me and had fantastic trades this week. It's starting to come together for a lot of traders. And again, other traders still struggling with some of the basic concepts. And again, today we'll review some of the basic concepts and talking about the big picture, looking at where the money is. Keeping this really simple. It's a really hard thing for retail traders. We get brainwashed with a lot of information from textbooks and trading books about systems and indicators and all these different things, and it's overwhelming with a lot of information. The whole purpose of the 50 pips a day strategy is to make it as simple as possible based on how the markets work. Narrowing that window down that you trade in to really a tight narrow window of when the highest possibility trade setups may take place, and then understanding if the market gets to that point and presents you with that opportunity, what it needs to look like and how it needs to behave for you to take a position in the market with a tight risk reward and an asymmetrical profit target to that risk. Meaning, 3, 4, 5 to 1, maybe 10 to 1 if you're getting really good at entering in specifically at a certain price. Again, we talk about using the 15-minute charts. I know other people have started to kind of hone it down on shorter time frames. Again, my biggest message is master the 50 pips first. Master the understanding and the mechanics of what's happening. Keep it really super simple. If you narrow that window down to the 12 candles, okay, I know, again, we'll just reinforce New York Eastern Standard Time. 8 to 11 p.m. is Asia. 2 to 5 a.m. is Europe, London. And 8 to 11 a.m. New York Eastern Standard Time is the New York session. We talk about the 3-hour windows. In that first 3 hours of every session, they will paint a high and a low. If the market extends out past that high or low in that second 3-hour window, that can tell us something about the market's behavior. Either perhaps it's going to be moving higher throughout the day, or it's moving lower. And again, what we're going to go through today can help us clarify some of the information behind that move. It's always about where is the money. I know a lot of people don't quite understand that yet about hitting stops. They talk about asking about stops from 3 months ago on the 4-hour charts and everything else. If there are positions in the market, they could be up for hedge funds, central banks, institutional money. They may have multiple positions in the market that are there sitting there for maybe long term in terms of yearly movements. They may be rolling over positions constantly. There may be pending orders at those levels because the market's revisited that level before. So they may be pending orders for breakout entries. They may be profit target orders there. There's a multitude of orders that could be positioned there for a number of reasons. So it's not just somebody who's taken a position and left a stop loss in the market. Those levels have technical significance to multiple time frame traders with multiple objectives. As I said, possibly new pending breakout orders, profit target orders. There may be existing stop loss orders there for longer term positions that are in the market. Every single day when you go to the market, when Asia opens up, we're going to ask ourselves one of two things, especially if we're inside of the previous day's range. So in the rollover, sometimes they may break out and break outside of a previous session's high or low, the US session. Or we may open up inside of the previous day's high and low and inside a previous session's high and low. So again, I've received a few questions. Do the previous sessions matter? Absolutely. I want you to think of one thing. Every session is a box, a high and a low, in that first 3-hour window. Now they may already be inside of London session or New York session, but when they've been inside of this, they either break out and they continue that move, or they break out and they pull back for a false break and move to the other side, or they break out and they pull back and they stay in a range-bound market. Every session relates to the previous session, because if they've gone to a level, okay, and they've hit stops in London from the previous sessions and cleared them out and pulled back, and then New York opens and they hit the stops from the London traders and they pull back and they go into consolidation, the next day you should be able to say there's money here and there's money here. And then there's money above the Asian highs and money below the Asian lows. Because as Asia starts to trade, they're going to create highs and lows where traders will be positioned in the markets and positioning stop losses in that market entry. So when we head towards the second 3-hour window, when we are inside of that range and we go into that next 3-hour window, that could be into the New York close, could be London, doesn't matter. So if we head into the New York close, there may have been a buy low set up down here. So traders are long, they go into the New York close and they break through, they break out, we're into the next day, and they come back and they hit it again and they hit it again on top of the New York session breakout. And they break out in the Europe-London open. They take out the stops from the previous day's high, and there may be another level over here from London the previous day where they head up to hit the stops. Those levels of highs and lows are where orders are built up, and when they clear out orders on one side and they reverse or they continue because there's more money down low than there is up top, they'll come back up top to make sure they clean off the board. So every single day you'll notice that almost every stop gets hit, and by the end of the week most of those stops all get hit. And if they don't, they'll come back later at some point to get them. And in a large majority of cases you'll notice that a lot of big moves occur in the Asian rollover, or when in a gap time when there's not maybe a lot of liquidity in the market. So every day when you draw your charts, mark off into the next session where the highs and lows are. Are you still inside of the previous US session? Did it break out of that US session? And if it did, is it consolidating on top or below for a move towards perhaps London stops from last week or from a US session stops from 2 days ago? Again, if you're drawing those brackets each day, you'll see a high and a low, and the market will be contained inside of those. And at some point it's going to move to one of those levels and either break through or hit the stops in reverse. So we'll look at some examples today on the charts. But again, I just want to reinforce high of the day, low of the day. So again, we could be inside of a high and a low, but that outer bracket is important because we're either inside of a previous session and we're working towards the highs or towards the lows, or we're breaking through a previous session to move towards another level. Okay, in timings, we talked about the 12 candle window. Okay, the first hour, the second hour, and the third hour. And often this first hour is a setup, it's a trap. Or it can be a trend trade, but it can be taking you into the last level way down low after 3 legs into the US Open for a reversal, or it might be taking you up high into a Europe or London Open for a reversal down. This first window is often the trap, and in that second window, in some cases, it can also be a trap for a breakout pullback. And as we hit into that third hour, that can often be where the real move takes place. But again, it all depends on whether or not they've hit the stops and cleared the board and they're reversing price action. We look for engulfments, pin hammers. off the low or the high of the day. If that market hasn't moved at the end of that second hour, okay, so London might go 1, 2, 3, 4, and there might be a bit of sideways price action here. After that first hour, the low of London and the high in London of London are in place. So the same principles apply. They either break through and continue, or it's working the high for a move back down to the low, possibly for a measured move, especially if it's inside of a Europe low anchor point in a down move from Asia. Again, we work from the high and the low, and we pay very specific attention to the time of day. So again, those Asia, London, and New York hours, that first hour is often a trap. Okay, and I've had a lot of questions about the iSessions colored box indicator. It's down in the description box. It's a free download. My timings are set exactly as I said, 8 to 11, 2 till 5, and 8 to 11. That's all that matters. Don't worry about if you got one bar too many or anything else. It's about the timings, the time of day, very specific, and whether or not you are down low or up high in that session. And then the main thing is looking at each session and knowing, have we broken out of that level yet? Are we still inside of the New York box or the London box? Where are the stops from the previous sessions? Have they been cleared off yet? Are we building up and pushing up high to hit all the stops down low? Are they trapping volume over 2 or 3 days up high and to shift the market? Or are they trapping it down low, 3 days down, consolidating, and then a big move up, trapping lower highs all the way down? Keep marking off all those levels where there are trades from the previous sessions where those stops have not been hit yet, because the market will come back to get those stops at some point. Whether it's today, tomorrow, next week, next month, those levels will get hit. So hopefully you got some value from that today, traders. We're going to go look at some examples on the charts. We're going to mark off last week's levels on a few of the pairs. Just going into Asia every single day, making sure you know when we open up where we're at in relation to the big picture about where the money is. Stay disciplined. Make this your best trading week so far, and may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading. Continuing our discussion on when the market opens, where is the money? It's important each day, each session, each week, when the week begins, looking at when the market opens up, are we inside of a previous session's range, or are we into an extended movement or a trend movement from that previous session? So each day we have a high and a low possibly. We may not, depending on how the market's closed, but we can mark off the highs and lows, knowing that that is where stop losses are. If there's been a move off the low of the day heading into the close, the market in this particular case, we're looking at the pound Aussie. On Thursday heading into Friday, it pulls back, drops down, and into the close. So now we have shorts and longs in the market, and we know that there is stops sitting above both of those traders' positions. So somebody shorted the market into the close. Somebody's gone long off the extended movement from the initial U.S. session low and high off the round numbers. So when the market opens, it makes a little mini high in that rollover session prior to the Asian market opening up. And obviously, early birds, first mice may have traded the swing thinking that was going to continue into the before the market opened. We talk about that first hour being a trap or a trade. In this particular case, the market has gone up to the numbers, stop hunted traders who were short, given us the inside bar, and in that pre-market hour, gone 1, 2, 3, 4 through the lows, consolidated, and the Asian market opens up one at the beginning of the next hour underneath of the double zeros, clearing out the stops from the previous day's low and extending the range out further. So now we have lower lows on the end of day time frame scenario before going into consolidation and hitting it one more time at the end of that 3-hour window and pulling back. So again, most important, mark off, we were outside, we extended the move from the US session. Traders went long, but traders who were trading the trend shorted that. They had some heat in that pre-market hour for the stop hunt up, 1, 2, 3 up, sideways, and the move back down with the trend. And again, now we come to the next session and we mark off our highs and lows because we know there are traders that are short in the market. And now off the bottom, heading into the Europe Open, we know there are traders that are long in the market. And of course, the market pulled back down, hitting stops underneath the London session, and then hitting them one more time, heading into the US Open after payrolls. Each session as it opens, ask yourself, where are the highs and where are the lows? And then let the market take you to that level. So the US market payrolls hits the stops from the London longs who have gone long off the low of the London session. They consolidate and give a 2-bar reversal before another bull candle on top of the previous day's low, consolidating and then taking out all the stops up top. And again, if you did nothing all day except wait for payrolls, you're down low after payrolls. They give a 1-bar pullback that stop hunts traders who are short going into payrolls. They go into consolidation. There's an engulfment on top of the previous day's low for the move back up through the money. All these orders are money, but each day, no matter what day it is, we can just go over to any random day, just scrolling, you mark off the previous day's session. So, and again, another example of extending the US session range before weekly pulling back. We mark off where traders have gone long. The market drops down into the Asian Open and goes sideways, hitting stops. Okay, then it drops through again, clears out traders who have possibly gone long at the previous day's low, hits those stops before pulling back 1, 2, 3. Again, that 1, 2, 3 pattern, look for that. It's all over the place for stop hunts. Then heading into the pre-hour of the hour before London, again, it gives us a swing low, and they clear out those stops and keep extending the move down. But each day we mark off that heading into Asia. Asia extended the range before pulling back to the round numbers, which is a stop hunt on traders that have gone short on that breakout out of the Asian session. Okay, they've gone down and then pulled back, stop hunted traders who have gone to break even. They haven't taken out the high. The market continues its move down, pulling back, and again now we get swing low where traders have positioned themselves and gone long thinking that that's the low of the London session. They want to go long, market goes sideways, they hit the stops again. And as we drop down further, we keep marking off our swing high levels. There are stops above those levels. And at some point the market will come back to get those traders, because there's traders who are building up short positions in the market, and we can see that a few days later cleared out all those levels. But my point is that each session, so in this particular case, the London session is below the Asian session. We head into the US session. We get a 1, 2, 3. The market opens and then goes 1, 2, 3 again to the highs, and then reverses. We have stops at the low of the day, and we have stops above the London rollover gap highs. So we have stops up top, stops down below. The market doesn't hit anything in between. It's consolidating. It does a 1, 2, 3 on swing traders on smaller time frames. Gets the shorts that were in the market early on the original move down. Takes out the lows, goes sideways. Pin hammers, 2 pin hammers, goes back and stop hunts traders who are short. The next day again, we mark off our highs and lows for Asia. The market takes out the previous day's low. We have US session high, so we're still inside of the US session range. So if we're inside of a box, we want to be buying low or selling high unless it breaks outside of that box. So they bring higher level longs up into the top part of that box. with stops below the low of the Asian session. They hit those stops, and after they begin the move down, we now have shorts who have stops above the highs of the day. They work it down, pull it back. They work it down one more time, pull it back. They hit it a third time, and it's on top of the numbers, on top of the previous day's low. 3 pushes down into a W consolidation for a move back through the highs of the day. But each session, you should be able to mark off where the money is. And if you're not sure, look to your left. So we have Asian session highs have stops above them. Okay. Swing highs from that rollover in the US transition. Okay. Scrunch this together. Doesn't matter what pair you do this on. Every single day as we head into Asia, are we inside of a previous session, or has the market extended the move out and continuing to move in a certain direction? It's really simple. Because again, above each one of these blocks, US, London, Asian session, are stops. They're orders. And those orders equal money. Because people are either going to take a loss, or they're going to have a breakout order, or they're going to have a profit target order. And all of those represent contracts that can be traded by our opposite counterparty, especially if the market is moving to hit the stops. However you want to look at it, filling orders, hitting stops, it doesn't matter. We know there's liquidity there. If we look at a different pair, we could look at the pound yen. Each day, ask yourself, are we inside of the previous session? No, we're not. So where their most recent trade swing is, there's obviously orders there. The market swings down, goes sideways in Asia, works the low of the day. We have stops above the high. We have stops above the low as we head into the Europe transition. Okay. And we have a move straight up high. And the last low before that move took off would have stops underneath. And the market came right back down to hit those stops. But again, where are the US sessions highs or lows? Okay, because that represents money. There's stops sitting there. There's a swing high that's significant, especially if the market has broken out of it, because the market will tend to come back and sit on top of those levels into the next day's session, possibly. And again, round numbers. So the market, you can see these swings, these session highs and lows often, even though they are outside of them, the numbers themselves, they're trading around those levels. Those levels are significant. And again, the market US session opens. If we mark off our high and our low, okay, just keep thinking, where's the money? Because when the market opens, it's going to go after the money. Doesn't matter where it is. The market will go and hit those stops. The market pulls back, clears out, goes down and gets the Asian longs before pulling back into consolidation. This is a great example right here of a session the next day where we open up and we're inside of a London swing high, which was the last swing high before the move down, and the US session swing low. So we mark off again, where is the money? The market moved above 50 in our rollover session. So again, if the market auctioned down in the US session and continued its move, then we have stops underneath of where that move turned around and started to go back up. So the market goes into consolidation, eventually hits the stops on that lower level high, heading into the Europe Open. We have a swing low, catching traders chasing that move long. Again, we wait for the 12 candle window. In that first hour, they hit the stops. They pull it back 1, 2, 3. They hit them one more time. They go 1, 2, 3 back to a swing high, taking out the stops of the shorts. And then hitting it one more time just prior to payrolls and the US Open. We'll just mark that off as well. Again, timings. If you were only trading the opens themselves, you can see that first hour, there's payrolls with the pins. They take you up to the high. They sell it down 1, 2, 3, the reversal, 4, the breakout at the US Open for a 50 pip move up. Again, if we squeeze this chart together, we can see again, where is the money? Where is the money? London highs, there's from the shorts, and the Asian highs from the initial move down. And again at numbers from 132.50. So heading into payrolls, we can look at this and go, okay, there's money down here. There's swing lows. There's some money down at the low of the day. They go sideways in the payrolls, go back inside of the high and the low. I'll just clear that last one as well. We're inside of the high and the low. They take out the highs, pull it back. 1, 2, 3 sideways, 4 breakout back long, and they go straight up to clear out the stops from the previous day's session. So every day, pay attention. Are you inside of the previous day's US range, London range, whatever it may be, and how are they responding to the highs and lows because there's stops at those levels? They may be going up there and protecting that level, as we saw on Friday, but they pulled back, jamming traders in down low, okay, catching swing traders following that move down before hitting the stops on payrolls, pulling it back 1, 2, and then 3 sideways for the move straight vertical. Mark up your own charts every single day. Here's another example on the pound. Just a random day. If we had marked off the previous day when the market opened, it was inside of US session lows, okay, and inside of London session highs. So we had the real high of the day and the real low of the day. Market was inside when Asia opened. Asia works its way to the high, doesn't take out any stops, goes back down to the numbers at the London Open, okay, sideways, and then an engulfment reversal, hitting the stops, going into an inside bar, hitting the stops down low again before going into consolidation one more time prior to the US market. And they 1, 2, 3 pull it back, 1, 2, 3 to the high again before we get another inside bar. So obviously the market is respecting that level where the London session high is. So again, when we head into the next day, we can see that the US session, the range went through the US session high. So we opened up inside of the US sessions high and low. Obviously, there was stops sitting above the pins, which they cleared out in that second 3-hour window. Went into consolidation, cleared out the stops from the US session highs. So 1 push, 2 push, 3 pushes, and gradually creep her up, cleared the stops, came back in Asia and cleared the stops, and then worked their way towards the high before pulling back without hitting the stops, clearing out the stops from the Asian longs. So every time they swing back and forth prior to the session, no matter even if you're trading Asia, it doesn't matter, they cleared them out. London Open, 1, 2, 3 to the high, inside bar in the 3rd hour in our 12 candle window after the stop hunt for the stop hunt back down to the low of the day and US session longs. Okay, so obviously there's break-even trades. You could be in this trade long off the US session low. You didn't take any money off. They came back and stopped you out as well as the low of the day. We go into the next session. We know that there are stops still at this level. Break-even stops. Okay, they go up into the US Open, they hit the stops and reverse and give an inside bar. Okay, same scenario. Bang, they go down, take out the lows of the traders who are long, chasing the move. And I talk about this in one of the other videos. Their fill prices, if they were in, even in that first hour of the trap, traders who shorted that got stopped out. But then traders who are long were also chasing price further and further away from the numbers. They come back, they hit the stops, they go sideways, they hit them one more time on traders who have gone long inside of the box. So again, we're looking at the outside. They extend the range. They extend the US session range out, go into the rollover, and again, they hit the low on traders who have gone long early. They hit the low again. They hit the low again in the Europe Open, and then stop hunt the high of the Asian and Europe long shorts. stop hunt the highs, okay, and they stop hunt traders who are in early in the Europe Open before pinning the high, going sideways with an engulfment in the London Open for the move, clearing out all the stops. Now, if we go back and look again, they're below the US session lows. So initially, that was our high and low. They protected that. Now, this is where we talk about taking your measuring tool from high to low and doing a projected range expansion. 100% range expansion takes us down just around the 23.25 level. Okay, and that expanded range in the next day's session after the breakout, 1 push, 2 push, 3 pushes back into the US Open for a continuation of that move down. So again, when the market opened, we mark off where are the stops, where is the money. So obviously there's money up top at the breakout level and down at the low. They go down 1, 2, 3 straight down sideways. Again, you can mark off the highs. We don't have any indication of a reversal whatsoever. Now we're into that next 3-hour window. And again, we mark it off. As we head into the next day, they go through that level right away, pull it back, and go sideways. So we mark off our highs and lows of those 2 sessions because we know there's stops above and below both of those areas, because that's where traders have gotten into the market long and they've gotten in there short. They pull it back just prior to the Asian close. People they've shorted the market following that move down. They do it a 3rd push before reversing into that Asia close, Europe Open. They clear the stops up top and continue the move straight through the highs on the BOE for a 75 pip, roughly 50 to 75 pip stop hunt long, and you can see that pin went into traders possibly who were short in that breakout. So again, each day, this is another example of where they extended the market out into the Asian session as opposed to the next day opening up inside of a US session high and a US session low, or a London high and a US low, however you want to look at it. They're inside of two sessions ranges. So we have orders up top and we have orders down below, and we just keep marking off those orders. Pound Canadian, another example, we walk into the next day's Asian session, we mark off our swing lows because there's traders that have gone long. We know there's stops down here. We know that traders are short from the US session up top, and again, the market may go up there and not clear out the high or the low because they only need to go up and stop traders out at break even. They may not clear that whole area out. They may be looking to trap volume. They give a pin hammer engulfment at the Asian Open, 3 bars, 1, 2, 3, reversal sideways for the continuation back down, hitting the stops down below before 1, 2, 3 in that pre-market hour. Again, the pre-market, they broke below the 50 pip box, pulled it back after hitting stops. We got stops above the London session after a 2-bar sideways move, and we got stops below the Europe pre-market open. Traders who have gone long have placed their stops after the stop hunt down low. Boom, for the measured move. So just emphasizing, marking off each day when you go into the new session where the money is sitting, money being the stops. Keep doing this, keep doing it until it's so repetitively obvious to you that all you see is where they're going to go to next, because nobody gets a free lunch, and every time they clear orders out, it's money in their pockets. So hopefully you got some value from today's video, traders. Follow the money. Before the market opens each session, ask yourself, where is the money? Have a great trading week.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.